So you're wondering how the new CARES Act or the bailout's going to affect you? We got your answers right here. Okay, so with all the economic calamity that's going on right now with the economy and the coronavirus, the U.S. government passed the Coronavirus Aid, Relief, and Economic Security Act, or known as the CARES Act. And don't you just love how they have all these cute names for all the laws? I wonder if D.C. has like a person whose only job is to figure out cute names for legislation. In fact, considering the waste in D.C., they probably have an entire department that's all they do, and it's probably called the Bureau under the lower level Secretary of the House and Interior Task Force, or bullshit, but that's another topic. So what we're going to do is we're going to go over everything in the CARES Act except for small business items, because that's a whole nother beast that we'll address in a different video. I'm going to use my notes today because there's so much in this that I don't think I could just wing it off the top of my head. But basically what this is trying to do is to help you navigate through a very difficult, tumultuous time in the economic world. Now, the big headline figure that everyone's talking about is the check. Am I going to get a $1,200 or $2,400 check? That's getting everything. But there's a lot of components here that could help a lot of people. So let's kind of jump in and talk about it. So again, let's start off with the headline. You know, this is what's getting all the media buzz, is the check, the rebate. And essentially what this is, and you need to understand this from the start, this isn't a bailout check, this isn't a one-time check, this is actually a refundable tax credit on your 2020 income tax return. Now, usually when you get refundable credits, it doesn't take effect until you file your taxes. So if you were going to file your 2020 return, you'd get this credit between January and April of 2021. What the government's doing here is they're just going to get it to you this year, right now. They're trying to just give you that refundable credit now. But all of this is going to come out on your tax return in 2020. So for whatever reason, if you're not getting it now or anything like that, you will get it. It'll just come out on the wash of your 2020 tax return. So that's the first thing you need to make sure you understand. So the basics are you get $1,200 for an individual, a single individual, and you get $2,400 for a married couple. For every child that's under the age of 17 in your household, that's a dependent, you're going to get another $500. Now you might wonder, why is it that under 17? Well, this is tied to the child tax credit. So if you're receiving a child tax credit now, you'll get the $500. If your child is 17 or older, including kids in college, you're not going to get this extra $500 per child. So basically, quick numbers, if you're single with one child, you're looking at $1,700. If you're married with two, you're basically going to get $3,400. So you can start to figure all of this out. Now, the key phrase in my last example here is could receive up to. So the recovery rebate is income dependent. So that means once you go above a certain limit, adjusted gross income limit, you're not going to get all of this credit. What's that figure? Well, the way it works is for every $100 of income above your credit limit, the recovery rebate drops by $5. So what are the limits? So your adjusted gross income threshold amounts for married filing joint, it's $150,000. So if your AGI is above 150 for married folks, you start to lose a little bit of this rebate. For head of household, it's $112,500, and then for married filing separate, or for single people, it's $75,000. So how does that work? Let's say you're a married couple, household income $170,000. That puts you $20,000 above the limit. So you divide that $20,000 by $100. That gives you $200. You then you take the 200, multiply by $5. That means $1,000. So you're going to get $1,000 less than what you would get if your income was under 150. Okay, does that make sense? This is a little chart that'll give you an idea of what the phase outs are for single, head of household, and married folks, from everything from no children up to 3 children. So you can take a look at this. You can pause it and look a little bit more if you need to. So again, at the outset, I said this is a 2020 refundable tax credit. It's all going to come out on your 2020 return when you file in January through April of 2021. So what's going to happen is right now the government's going to either look at your 2018 or 2019 taxes to determine the amount that you're going to get, what your eligibility is. So now here's the thing. Let's say, for instance, you made too much money in 2018 and 2019. So now in 2020, you've been laid off, you're not going to have very much income, you could really use that credit. The problem is you're not going to get it this year, this calendar year. You will get the credit, but it's not going to be until you file for your 2020 tax return. So you'll get it sometime again early 2021. You will get it, you're just not going to get it now when it would probably be most useful to you. If you do get the credit based on your 2018 or 2019 return, and it turns out in 2020 you make too much money, let's say you sell toilet paper on eBay or Amazon and you're just making a boatload of cash right now, you're not going to lose the credit. So when you file your 2020 return, they're not going to claw that back. So if you're lucky enough to where you're making more money this year and you were qualified before, but you wouldn't be qualified based on your 2020 income, they're not going to take that away. So you're kind of gaming the system. You got lucky. So you can obviously, there's going to be some flaws with this process. The other thing it doesn't look at it, if you changed your, if you got divorced during the year, if you had more children in either 2019 or 2020, if somebody in the household passed away, none of that's going to be incorporated. So again, this isn't a perfect system. It's going to be pretty close, but then it all gets caught up when you file your tax return in 2021. Okay, so a lot of questions are coming out. What if I only get Social Security, or what if my income's too low that I don't have to file an income tax return? Here again, you're going to be lucky. The IRS says they're going to be able to figure out your credit just based on your Social Security. So if you're not filing tax return, don't freak out, because they're going to figure out what amount you should get based off of your Social Security. Okay, the other thing is, when am I going to get it? That's the other question we're getting. When are we going to get these things? I understand people want to get the money. The government has mandated that they process as soon as possible, but we're looking at least 3 weeks from what I've seen. So we're talking late April or early May is when this is going to happen. Next question we're getting a lot is, how do I get the recovery rebate? So here again, if you are getting Social Security benefits, they're going to use the account that they deposit your Social Security amounts in each month. And then they're going to do direct deposit for your recovery rebate. That's where it's going to go. If you don't get Social Security, they're going to look at your 2018 or 2019 return. If you got a refund, they're going to deposit it into the account that you used to get your refund. So it'll just be direct deposited in. If you owed on your tax return and you did not provide your bank information to the IRS, they're going to send it to a check to you via your home or record on either 2018 or 2019 return. Here again, you can see there's some problems. One, you might have moved, so the check's not going to get to you if you moved. You might have changed your bank account. So maybe the bank account you used in 2018 or 2019 is no longer valid. If that's the case, what you're going to want to do is actually call the IRS. So you'll see this number that we're going to post here, but it's 1-800-829-1040. You're going to want to call them up and update either your address or your bank account information. Even if you owed and did not provide the IRS your bank information, you can call and give them your bank information if you prefer to get direct deposit versus a check. Now, I'm going to forewarn you, anytime you call the IRS at that number, you need to expect a long wait time. I mean, I'm talking at least an hour. Now we're in a situation where there's probably going to be a lot more calls, and the IRS has reduced staffing due to the virus. So what you might want to do is start to go through your binge watching of Better Call Saul season 5, because it's going to take quite a bit of time to get through. So just sit there with the phone, let it play its music and all that good stuff, and just wait it out. But that's how you're going to update that information. Okay, so that's the quick rundown on the headline rebate check that you're going to get, but there's a lot of other things in here. The next thing you want to look at that they changed is they made a lot of qualified opportunities for you to take money from a retirement plan. So an IRA or 401k. Now, before you think about doing something like this, make sure it's your last-ditch effort. As a financial planner, I'm imploring you not to take money from your retirement accounts, because what I always find, as soon as people start to see their retirement accounts as more of a savings account that they can access, they end up not saving nearly as much. It changes their mentality, and that money just never grows. Anyway, they did put this in here for an emergency, so if it is a last-ditch thing, the very last thing that you've got, you can access it. So what they're doing is they're allowing you to take up to $100,000 from your IRA, employer-sponsored retirement plan, or a combination of both. The distribution has to be made in calendar year 2020. So you have until December 31st of this year to do it. And you must be impacted by the coronavirus. That means either you had the virus, a spouse or dependent had the virus, you were either quarantined, laid off, or furloughed because of the virus, you were unable to work because you had children at home and you were unable to get child care, you own a business and had to close your business because of the virus, and then there is another catch, any other situation where the IRS deems it okay. So there's a big catch-all there. So for the most part, as long as you're not taken out to buy a boat and you're employed the whole time, I think you're going to be good. You can make up an excuse if you had to. So the money is there. They are offering massive discretion here as to what constitutes an entitled distribution. Now, what does a distribution do? Well, the first thing, you're not subject to the 10% penalty if you're under age 59 and a half. The government is going to waive that. Usually when you take money out before 59 and a half, you pay income tax and a 10% penalty. 10% penalty is gone. You still have the income tax though. You're still going to pay the income tax. The other thing is it's not subject to the mandatory withholding rates. So a lot of times when you take money out of a 401k, 403b, or an IRA, you're going to have to withhold at least 20% for taxes. They're going to waive that. So you're going to get the whole amount in your bank account. So that's good. But remember, it's bad though when you go to file your taxes. The other nice thing that they did with this is they're allowing you to roll it over in the next 3 years. So let's say you take out $20,000 to get you through the next couple months till work gets going again. Well, you have 3 years to put that $20,000 back into your IRA or roll it over into an IRA. And then you're not going to have to pay tax on that. So this does provide an opportunity. So I really, again, I hate it when people take out of their IRAs or 401ks. But if you do, you've got 3 years to put that money back in and get things going again. So that's good. That's a great feature to this. Now, the only bad part about that is you're going to have to pay tax when you take this money out. So if you don't roll it back over this year, more than likely you're going to start filing some tax returns where you pay the tax. If you then, within the 3 years, go back, roll it back into an IRA, you're going to also have to amend your tax return to get that tax money back. But here again, that's just extra administrative thing. This is a good opportunity to take the money out, put it back in, not pay taxes, ensure that you've got your long-term savings. The other nice thing that they did is they said you can spread the distribution out for tax purposes over the next 3 years. So usually when you take money out of an IRA or 401k, you're taxed on that entire amount in the current year. So if you took $20,000 out this year, you're taxed on $20,000. They're allowing you to spread that out over 3 years to minimize the tax bite. Now, if your income drops a lot this year, to the point where you're really not working much at all, you may still want to do it all in tax year 2020, and then not do it for those last 2 years. But if you think your income is going to be pretty level over the next 3 years, you can split that up, pay the taxes over a 3-year period. Another thing they did with IRAs and 401ks is they have waived the required minimum distribution for 2020. So if you're taking out, if you're over 70 and a half and you've been removing money from your IRA, if you don't need that money, you can leave it in there. You do not have to take it out this year. If you've already taken your RMD for the year, you can actually put that money back in to your IRA or a retirement plan. If you're within the 60 days, usually what happens if you take money out of a retirement plan and roll it within 60 days, there's no penalty, no tax. If you're still within that 60-day windows, this is an easy transaction to rectify. If you're past the 60 days, so if you took it maybe the beginning of January, it's a little bit trickier, but we go back to that 3-year IRA rollover. You do still have 3 years to put it back in, but more than likely you're going to have to file a tax return or amend the tax return to get your tax dollars back. So a little bit more administrative stuff, but you can still get it all back in there. Now, let's say you inherited an IRA from your mom or dad when they passed, or an aunt, uncle, grandparents. You still have to take the RMD. So if you have a beneficiary IRA or retirement plan, you still have to take the RMD. There is no provision in the tax code for somebody with a beneficiary IRA to do any kind of rollover. You can't do that. So you still have to take it, you still have to pay taxes on it. So if it's your own IRA or retirement plan, you can actually waive the RMD. If it's inherited, you can't. Okay, some other little things. I really like this. I think they should make this permanent, but they've put a provision in to allow you to deduct some charitable expenses even if you don't itemize on your tax return. So now they've created what they call a $300 above the line deduction. What above the line means, it's before we calculate your adjusted gross income. So you list all your income on your tax return, then you have adjustments to income. That's where it's going to show up, your adjustments. So it's a $300 deduction from your income. And again, this is even if you don't itemize. And for a lot of people, ever since the Trump tax bill got passed, he increased the standard deduction / your and itemized to the point where your standard deduction is much bigger for most people now. In fact, 90% of people now take the take the standard deduction over the itemized deduction. Only 10% still itemize. You can only take charity if you itemize right now. This is allowing people who don't itemize to at least get $300. Yeah, it's a little bit low. I'd love to see it maybe be a couple thousand, but at least we're getting something. So we now have $300 if you're doing charitable. Now, this has to be a cash donation. It can't be giving goods to Goodwill, anything like that. It can't be donated goods. It has to be cash donations. And it also cannot be cash that goes to donor advised funds or any kind of private foundations. But it's something. Another thing for charitable, so for people who do itemize, right now the law is structured that you can donate up to 60% of your adjusted gross income and get a charitable deduction for that. So if you make $100,000, you could donate $60,000 and take a full deduction on your itemized deductions. They're going to bump that up to 100%. Now, if you're giving away 60% or more of your income, God bless you. But I just want to let you know that that is eligible for people. Another item that's kind of changing on the tax return is eligible medical expenses. It used to be you can only deduct medical expenses that have been prescribed or visits to doctors, things along those lines. They're going to allow you to deduct over-the-counter medical expenses when you're using a health savings account, a flexible spending account, or the Archer medical savings accounts. So now you can do things, if you're getting some kind of Tamiflu or something along those lines, you can deduct that. While we're talking about medical, there's a few additional medical benefits in the plan. So medical or Medicare beneficiaries will be able to receive a coronavirus vaccine once it's available at no cost. Also, During the COVID-19 emergency period, Medicare Part D recipients must be given the ability to have, upon request, up to a 90-day supply of medication prescribed and filled. So that's good. And then they're also going to open up telehealth services, which typically weren't covered before, but they're going to be able to be covered now by high deductible plans as well as HSA eligible plans. Okay. Another big area is going to be education provisions. So there's a lot of different things that have changed here. So if you have student loans, this is for you. So if you have any student loans, this is the section for you. And they are doing quite a bit to try to help you out. So student loan payments are deferred until September 30th, 2020. During this time, no interest will accrue on the debt. Now, unfortunately, while this is for required payments, they're suspended, but voluntary payments are not. Okay, so if you're doing voluntary payments, you have to continue doing that. And the thing is, the payments will have to continue unless you actually take proactive measures to contact your loan provider and pause the payments. So you have to call your loan provider and tell them you want to pause your payments until September. Otherwise, the government assumes you're going to continue to make the payments, on time as it's been laid out. Okay, so make sure you contact them. Also, notable is that this period of time will continue to count towards any loan forgiveness programs. So if you're trying to qualify for a program that ultimately will forgive the entire federal student debt, such as the Public Service Loan Forgiveness Program, this pause does not affect you at all. This is kind of a big bonus. The other thing is you want to call and make sure that you get it paused, because why would you not? Even if you can make the payments, you get a free pause here. This is stuff you're not going to have to pay back. If you end up qualifying for it and you get it all paid off for you, why make these payments? Okay, so you want to call, get it paused, and then you might not ever have to pay this back. So that's a huge benefit for you. The other thing they're doing, all involuntary debt collections are also suspended through September 30th. This not only includes wage garnishment or the reduction of other federal benefits, but also the reduction of any tax refund for student loan purposes. So if you were getting refunds and the IRS was assessing those refunds to pay back student loan debt, they're going to stop that. So you're actually still going to get your refund. So that's a great reason to go out and file. Borrowers of student debt who are delinquent on payments and would normally be subject to a reduction of their tax refund are going to get that back. Another education benefit in the law is if a student withdraws from school during the middle of a semester because of a qualifying emergency, so you got the virus, you had to go home, help somebody with the virus, you're basically not going to have to pay back the Pell Grant if you received one, or you're not going to have to pay back any direct loan you received to pay for school. Okay, so that's going to be forgiven. This also applies if your school sent you home. You're not going to have to pay that stuff back. So that's another big benefit in this new bill. The last thing I'm going to talk about here is unemployment benefits. And I think this is probably the most important and hasn't gotten as much press as, say, the $1,200 check. But I think this is where you're really going to help people, because that check, a lot of people don't need it. And their income might qualify them for it, but they don't need it. If you're unemployed, you got a need. So I'm glad they did something here. I wish they would have done more. This is the area that can keep folks who don't have jobs just so they're going to stay afloat. So there's a few things that they did here. The first one is really unique, is self-employed individuals and other individuals who are ineligible for regular unemployment are now going to be eligible for up to 39 weeks of benefits via this provision. So this is going to help the restaurant and retail shop owners who otherwise wouldn't get unemployment benefits. They're going to be able to get 39 weeks of unemployment. So if your business goes under or it's close to it, you want to get some unemployment, this is an opportunity to do so. So the other thing the government's going to do is they're going to cover you from the first week of unemployment. Now, if you've ever been unemployed before, you know that the first week of unemployment is never covered. because they don't want to give you an incentive to go on unemployment. They want you to keep looking for a job. They figured if you're not getting money the first week, you'll keep looking or try to work in some fashion. So right now, they're going to offer it from the very first week that you're unemployed. The other thing they're going to do is the federal government is going to bump up your unemployment by $600 per week. And this is pretty huge. When you figure that the average weekly unemployment benefit at the state level is only $400 a week, they're going to bump it by 6. You're now getting $1,000. Okay, so that's fantastic. And the other thing is they're going to do is they're going to extend the unemployment for an additional 13 weeks. So you're going to get an extra quarter of unemployment in this situation beyond what you normally would get going through the state unemployment agency. Okay, so there's a lot in there for unemployed folks. There's a lot more in this bill too. I didn't even address the close to $400 billion that's going to go for bailouts. I'm not really happy about that per se. That's going to the big companies. We'll do another video, a little podcast on that. And this also doesn't address the small business issues. We will do that in a different video. That's a little bit, that pertains to a lot more, fewer folks. So I didn't want to waste your time with that if you're not a small business owner. So we'll get that stuff out to you quickly. If you have questions on this, please leave a note on the YouTube page. You can go to our Saving Yourself from Wall Street website, send a question that way, or just shoot us an email. We'll try to answer as many questions as we can.